Chapter 2. How We Got Here. A brief history of American taxation. The story of American taxation begins with a constitutional provision designed to protect slaveholders. What the framers called the Direct Tax Clause, born of the original compromise over slavery, became the legal barrier to taxing accumulated wealth. Tracing how we arrived at this inheritance helps explain why incremental reform keeps stalling and why fundamental redesign deserves serious consideration. The tax code is not the product of a single design session. It is the accumulated result of 2 centuries of legislation, each provision added by someone, for someone. The pattern across that history is consistent. Each reform creates new opportunities for avoidance, each loophole gets exploited, and the system grows more complex while becoming less effective at its stated purpose. The original design, from 1789 to 1913. The founders deliberately avoided direct taxation. The federal government was funded primarily through tariffs, taxes on imported goods, and excise taxes on specific products like whiskey and tobacco. This worked for a small agrarian nation with limited federal responsibilities, but it could not scale. The Constitution's treatment of direct taxes reflects an ugly compromise. Article 1 requires that direct taxes be apportioned among the states according to population. This provision was linked to the 3/5 compromise. Southern states wanted enslaved people counted for congressional representation, and the apportionment requirement was part of the deal. If direct taxes were apportioned by population, states with large enslaved populations would bear higher tax burdens, theoretically offsetting their increased representation. The federal government's first attempt at income taxation came during the Civil War. The Revenue Act of 1861 imposed a flat 3% tax on incomes over $800. By 1865, the rates had risen to 10% on incomes over $10,000. The tax was administratively successful, raising significant revenue for the Union war effort. After the war ended, it was gradually phased out and repealed entirely in 1872. The Civil War income tax proved something important. Income taxation was administratively possible. The federal government could identify taxpayers, assess their incomes, and collect what was owed. The question was whether it was constitutional. In 1894, Congress passed a new income tax, a 2% tax on incomes over $4,000. The following year, the Supreme Court struck it down in Pollock versus Farmers Loan and Trust Company. The court ruled that taxes on income from property were direct taxes, requiring apportionment by state population. Since apportionment was unworkable for an income tax, meaning it would require different rates in different states based on population rather than income, the decision effectively prohibited federal income taxation. Justice John Marshall Harlan dissented vigorously, warning that the decision would make it impossible to tax accumulated wealth. He was right, until the Constitution was changed. The Income Tax Amendment of 1913. The Pollock decision created a constitutional crisis. But the years that followed were not spent building support for an amendment. They were spent trying to work around the court's ruling, hoping the problem would solve itself. Once reformers committed to the amendment path, momentum built quickly. Progressive-era reformers, populists, and labor unions organized. The campaign built pressure state by state. Legislatures passed resolutions calling for an amendment. Politicians who opposed it faced electoral consequences. By 1909, the political moment had arrived. President William Howard Taft, a Republican, supported the amendment. Congress proposed it with near unanimous votes, 77-0 in the Senate and 318-14 in the House. When the political will was clear, the constitutional barrier fell. Ratification took less than 4 years. 42 states ratified, well above the 36 required. The 16th Amendment became law on February 3, 1913. It reads as follows. The Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. The original income tax was modest by today's standards. It imposed a 1% tax on incomes over $3,000, equivalent to roughly $98,000 today. Rates graduated up to 7% on incomes over $500,000. Only about 2% of the population paid any income tax at all. The original intent was clear: tax the wealthy, spare the workers. The income tax was designed as a levy on accumulating capital wealth, not on wages. It took decades for that intent to be inverted. The 16th Amendment did not emerge from nowhere. It was the culmination of a tradition that runs through American politics like a fault line. Henry George's book, Progress and Poverty, published in 1879, argued that the fruits of civilization belong to the civilization that produced them. It sold 3 million copies in a country of 60 million. The populist movement of the 1890s organized farmers and workers around the same principle: that concentrated wealth owed a duty to the Commonwealth. The progressive reformers who pushed the amendment through Congress were heirs to that tradition, not its inventors. The idea that wealth should be visible and accountable is not new. It is unfinished. The lesson for today is worth noting. Constitutional barriers to taxation can be overcome, and faster than most people expect. Once Congress proposed the amendment, ratification took less than 4 years. It takes organization, sustained advocacy, and political will. But when the moment arrives, change happens fast. The growth of complexity, from 1913 to 1980. The income tax started simple. It did not stay that way. World War I transformed the tax system. Rates rose dramatically to fund the war effort, and the top marginal rate reached 77% by 1918. More importantly, the tax base expanded. Exemptions were lowered, bringing more Americans into the system, and the first major deductions and exemptions were created, planting the seeds of future complexity. The 1920s brought rollback. Top rates were cut to 25%. Wealth concentrated rapidly during the Roaring Twenties. The crash of 1929 and the Great Depression followed, a pattern that would repeat. The New Deal and World War II transformed the income tax into a mass levy. Top rates rose to 94% by 1944. More significantly, withholding was introduced in 1943. For the first time, taxes were deducted from paychecks before workers ever saw the money. This was administratively efficient, and it created a fundamental asymmetry. Workers paid immediately and automatically. The wealthy, whose income came from investments rather than wages, retained control over when and whether to realize taxable income. The post-war period saw an explosion of complexity. Each new provision in the tax code created new avoidance strategies. Tax lawyers and accountants became essential for anyone with significant wealth. The code grew from a few dozen pages to thousands, then tens of thousands. A cycle established itself. Reform, capture, new loopholes. Congress would pass legislation to close one avenue of avoidance, and the tax planning industry would find 3 more. Complexity became a feature of the system itself. By 1980, the tax code was already labyrinthine. But the most consequential changes were still ahead. The capture, from 1980 to the present. Over the last 4 decades, a series of policy changes have reshaped the tax system in ways that consistently favor wealth over work. Each round of reform created new avoidance routes for the wealthy, while ordinary workers continued to pay. First, declining top marginal rates. In 1980, the top marginal income tax rate was 70%. By 1988, after the Reagan tax cuts, it had fallen to 28%. Today, it stands at 37% nominally. But the nominal rate tells only part of the story. Second, capital gains preferences. Long-term capital gains, meaning profits from selling assets held more than a year, are taxed at a maximum rate of 20%, compared to 37% for ordinary income, like wages. This preference is justified as encouraging investment, but its primary effect is to ensure that the wealthy pay lower rates than workers. The carried interest loophole allows hedge fund and private equity managers to treat their compensation as capital gains rather than ordinary income. A fund manager earning $50 million pays a 20% rate, while a surgeon earning $500,000 pays 37%. Warren Buffett famously noted that he pays a lower tax rate than his secretary. Third, corporate tax avoidance goes global. Multinational corporations developed sophisticated strategies to shift profits to low-tax jurisdictions. Transfer pricing, which means charging artificially high or low prices for transactions between subsidiaries, moves income to tax havens. Intellectual property is held in Ireland or the Netherlands, where royalty payments reduce taxable income in the United States. The statutory corporate tax rate has fallen from 46% in 1980 to 21% today. But effective rates, what corporations actually pay, are often far lower. Some of the most profitable companies in the world pay little or no federal income tax in many years. Fourth, the buy, borrow, die strategy. This is the ultimate tax avoidance technique, available only to the very wealthy. It works in 3 steps. First, do not sell appreciated assets. If you own stock that has increased in value, you owe no tax until you sell. So do not sell. Your wealth grows, but you have no taxable income. Second, borrow against your assets. Banks are happy to lend against a portfolio worth billions. Loans are not income. You are not selling anything, just borrowing. You can live lavishly on borrowed money, paying low interest rates, while your assets continue to appreciate tax-free. Third, die. When you die, your heirs receive your assets with a stepped-up basis, meaning their cost basis resets to the current market value. All the appreciation that occurred during your lifetime is never taxed. The gains simply disappear. This is the logical result of a system that taxes income rather than wealth, that preferences capital gains over wages, and that resets basis at death. In 2022, Elon Musk acquired Twitter for $44 billion. His original financing plan included a $12.5 billion margin loan secured by his Tesla stock. Unrealized, untaxed wealth deployed as purchasing power. Banks were happy to lend against it. They could value Tesla shares to the penny every second of every trading day. In that structure, Musk could have spent $12.5 billion of his wealth without selling a single share and without triggering a single dollar of tax. Loans are not income. The man whose true tax rate was 3.27% was prepared to deploy $44 billion in a single transaction. If the banks can value it precisely enough to lend billions against it, the wealth is real. Fifth, IRS defunding. Even the rules that exist are barely enforced. The IRS has been systematically defunded, with consequences Chapter 4 examines in detail. The result? An estimated $696 billion gross tax gap goes uncollected each year, according to the Internal Revenue Service's tax gap projections released in October 2024. Wealthy taxpayers and their representatives in Congress have systematically weakened the agency responsible for enforcing tax laws. An underfunded IRS cannot close the gap. Where we are now. The current system produces predictable results. It was built through decades of incremental decisions, each one rational from someone's perspective, and the cumulative effect is a structure that treats work and wealth very differently. Workers pay immediately. Wages are subject to withholding. Taxes are deducted before you ever see the money. Payroll taxes, meaning Social Security and Medicare, take another 15.3% off the top, split between employee and employer. A worker earning $60,000 might pay an effective federal rate of 20 to 25% when all taxes are included. That split between employee and employer deserves scrutiny. It is an accounting fiction. The Congressional Budget Office and the Joint Committee on Taxation both treat the employer's share of payroll taxes as part of the worker's total compensation cost. Mainstream economists agree. The employer's 7.65% comes out of what the employer would otherwise pay the worker in wages, according to a Congressional Budget Office working paper from June 2021. Here is how it works. An employer budgets $65,000 for a position. Before the worker sees an offer letter, $4,973 is set aside for the employer's share of Social Security and Medicare. The job listing says $60,027. The worker never knows the position's real compensation capacity. She negotiates from $60,027, not from $65,000. Her own payroll taxes and income tax withholding then reduce her take-home pay further. She sees roughly $45,000 in her bank account and believes that is what the job pays. The effect is wage suppression. The employer's payroll tax is invisible to the worker, but it is real in its effect. It does not appear on any pay stub. It is not discussed in any job interview. It depresses every wage offer in the economy by 7.65% before the first dollar is negotiated. The implication for reform is a double dividend. Eliminating payroll taxes does not just end the tax on the worker's paycheck, it ends the invisible tax on the worker's job offer. The worker's taxes disappear, and the employer's cost of employing her drops by 7.65%, creating room for wages to rise. For a worker earning $60,000, that is nearly $10,000 in combined benefit. Roughly $4,600 in eliminated employee payroll taxes, plus $4,600 in freed employer capacity that market competition pushes toward higher wages. The benefit is larger than most people calculate, because most people do not know the hidden half of the tax exists. Wealth pays never, or at least not until the owner chooses. Investment gains are not taxed until realized. Borrowing against assets is not taxed at all, and death resets the basis, erasing a lifetime of untaxed appreciation. The results are stark. ProPublica's analysis of leaked IRS data revealed the true tax rates of the wealthiest Americans, calculated as the taxes they actually paid divided by the growth in their wealth. Warren Buffett paid 0.1%. Jeff Bezos paid 0.98%. Elon Musk paid 3.27%, the same man who was prepared to deploy $44 billion to acquire Twitter. Michael Bloomberg paid 1.3%. Meanwhile, a teacher or nurse earning $60,000 pays 20 to 30% in federal taxes. The system is regressive in the truest sense. Those with the most pay the least. Incremental reform has not changed this trajectory. Every loophole closed creates two more. Every rate increase is offset by new avoidance strategies. The complexity itself creates infinite opportunities for those with resources to exploit it. Understanding why gets us to the central question. What would it take to build something that actually works? The structure is the problem. 2 centuries trace the same cycle. Crisis forces change. Change brings complexity. Complexity rewards whoever can afford to navigate it. The wealthy fund the politicians who protect the complexity. Incremental fixes get absorbed. The cycle resumes. This cycle has been broken exactly once. The 1913 income tax took 18 years, a constitutional amendment, and a generation of organizing. It happened because reformers stopped trying to patch the existing system and recognized that no amount of patching would be enough. The structure had to be replaced. We are at the same moment. The income tax began as a levy on the wealthy. Decade by decade, it has been reshaped into a levy on work.